There is a comprehensive list of audit risks that may arise while analyzing financial statements. For each risk indicator, risks are mentioned. Foreign currency, supplier, loan, imports. There is a risk of translation errors in inventory, purchases, payables, forex gain/loss. Misstatements in above due to currency fluctuations. Wrongly debited/credited to purchases instead of forex gain/loss in income statement. Product no longer in use. Major contract expired. Decrease in demand. Decrease in sales plus increase in inventory. High fashion products. License revoked. There is a risk of fixed assets may be overstated, value and use may be reduced. Specific asset may be impaired. Obsolete inventory should be written down to NRV. Not be able to sell affected inventory. Brand becoming less fashionable. Inventory records plus estimation of work in process. There is a risk of judgment error. Risk of material misstatement. Related parties. There is a risk of transactions not fully disclosed. Revaluation. There is a risk of judgment error. Adjustments not correctly accounted for. Fast-moving technology. There is a risk of older system may become obsolete. Brand name. There is a risk of decrease in revenue indicates impairment. Promoting brand name may be wrongly expenses. Tax liability calculations. There is a risk of material misstatement. Judgment to assess the outcome. Budget/projections. There is a risk of manipulation to show better results. License, intangibles. There is a risk of compliance risk. Operational risk. Wrong treatment as expense. Amortization calculations. Impairment reviews. Staff turnover and training. There is a risk of should be expensed. Increase in control risk. Loss of experts. Errors in non-routine transactions. Unethical practices/fraud. Cash flow problems. There is a risk of financial risk. Going concern problems. Disclosure risk. Increase in insurance. There is a risk of operational risk that will result in decrease in customers and company may become uninsurable. Contingent liability disclosure omission/inappropriate disclosure. Centralized reporting. There is a risk of inaccurate reporting by divisions. Advance receipts for services. There is a risk of services may not be available. Provisions understated. Revenue overstated and liabilities understated. Customer dissatisfaction. There is a risk of going concern issue. Legal claims, fines. Right issue. Loan obtained. There is a risk of pressure to show better results. Fraudulent financial reporting. Self-constructed asset. There is a risk of impairment issue. Asset may be overvalued. New ERP. There is a risk of improper implementation of ERP. Improper capitalization, IAS 38. Useful life. First-year audit. There is a risk of lack cumulative knowledge and experience, failure to identify significant events and transactions. Opening balances may be misstated / not correctly brought forward. Inconsistent accounting policies. Opening balances may be misstated / no director / lack of oversight of senior management. There is a risk of weak control environment, undetected errors, closely held entity / major positions held by family members. There is a risk of weak control environment, undetected errors, guarantees. There is a risk of transparency in doubt. Decisions are influenced. Ineffective governance, management override of controls. Fraud risk. Online sales. There is a risk of judgment due to subjectivity. Risk of material misstatement. Subcontractors. There is a risk of sales returns. Insufficient provision for sales return. Error in integration of online sales system to GL. Refurbishment. There is a risk of invoices may be received at or after month / period end. Fail to accrue cost. Liabilities understated. Loan. There is a risk of capital versus non-capital items. Going concern assumption inappropriate. Increase in overdraft / loan. Major contract renewal. Consecutive losses. Current liabilities, current assets. There is a risk of classification error. Going concern issued due to non-compliance with terms and conditions. Immediate liability may occur if covenants are breached. Classification of long-term to short-term. There is sale of assets. There is a risk of correct removal entries. Profit / loss accounting and disclosures. If loss. Asset life. Carrying amounts. Assets held for sale, IFRS 5. There is a risk of held for sale should be lower of cost / NRV. Depreciation should not be calculated. Assets not clearly distinguished in FS. Criteria for classification as HFS not met. Improper disclosures. Life, residual value, impairment, fair value. Redundancy. Closed business / segment. There is a risk of incorrect accounting and disclosure. Inadequate provisions. Constructive obligation. Criteria for provision may not be met, wrongly provided for. Sudden sales increase. There is a risk of sales overstated receivable days. Early revenue recognition. Cutoff errors. Changes in revenue recognition policies. Website upgrade, SIC 32. There is a risk of assets overvalued. Expenses understated. Losses, deferred tax asset. There is a risk of deferred tax asset is recognized to the extent that company expects that it would generate sufficient profits in future to realize the benefits. Profits overstated. Scrap sales. There is a risk of illegal transfer of funds. Abnormal losses. Defected inventory. Inventory valuation. Impairment of fixed assets. Installment sales. There is a risk of interest Interest income should be booked as other income rather than sales. Food business slash farming. There is a risk of inherent risk. Legislation may result in fines. Adverse publicity, sales decrease. Outside direct control of management. Depends on economic slash seasonal factors. Bad publicity. License revoked. There is a risk of contingent liabilities understated. Fines slash penalties. Tight audit deadline. There is a risk of limit subsequent events testing for evaluating estimations. Sale and repurchase. There is a risk of loan may be secured on inventory. Risk of cash booked as sales. Entry should be doctored cash CR liability. Interest, borrowing cost. Expenditure on infrastructure. Circular debt. There is a risk of impairment of asset. Suits slash cases. There is a risk of current liabilities may require provision slash disclosure. Non-compliance with regulations. Suits relating to current period may be filed after period end. Performance-related bonus. There is a risk of fraudulent financial reporting. Increase in capital expenditure but decrease in sales. There is a risk of impairment of fixed assets. Decommissioning cost. There is a risk of criteria for recognition. Provision not appropriately recorded and disclosed. Outsourcing. There is a risk of use of service organization. Sales commission to distributors. There is a risk of judgment, will they be able to achieve targets? Accrued sales commission. Customer loyalty. There is a risk of judgment about future purchases and points redemption. Risk of material misstatement in revenue and associated liability. Receivables increase. There is a risk of old outstanding. Classification issues, long-term. Risk of material misstatement in revenue and associated liability. Discounting. Leased asset. There is a risk of CAPEX slash OPEX classification. Inappropriate disclosures due to complexity. Life estimation. Major supplier abandon. Quality issue. There is a risk of inventory overvalued. Provision of obsolescence. Increased cost. There is a risk of pending orders may result in onerous contract. Provisions may be required due to present obligation. Profits projection. Inventory may exceed NRV. Gross profit decrease. There is a risk of purchases overstated. Inventory understated. Bulk purchase discounts may be received. Cutoff errors. There is operating profit decrease. There is a risk of misclassification in cost of sales versus operating. Assets wrongly expensed. Inventory days increase, overstated. There is a risk of slow-moving slash obsolete. Translation error. Counting error. Cutoff issues. Payables decrease, cost increase. There is a risk of payables understated, unrecorded invoices. Tighter credit terms. Translation error. Early payment discounts. Increase in distribution centers. There is a risk of inventory. In transit. Completeness. Existence. Physical verification. Inventory inflated. Risk of theft. Kindly like, subscribe and press the bell icon.